They didn't just sell silver. They yanked the floor out, watched everyone tumble, and then quietly bought the rug back at the lowest possible price. And if you think that sounds dramatic, good, because what happened was dramatic. Because here's the part that should make you sit up straight. The biggest player on the field appeared to close a major bet right at the moment the market hit the bottom. Not near it, not kind of, right on it. Because the official explanation is tidy. Too tidy. It goes like this. A surprise shift in central bank leadership expectations spooked markets. The dollar moved, and metals reacted. End of story. Neat little bow, everyone can go home. Except that version ignores a chain of events that, when you stack them together, starts to look less like chaos and more like choreography. And I'm going to lay it out in a way that actually makes sense, without the fluff, without the panic, and without the lazy talking points. But first, let me set the stakes. If you hold physical silver, silver funds, mining stocks, or even just a portfolio that depends on stable markets, you just got a preview of how quickly confidence can be shaken. The same move that scares people into selling can also hand a gift to the people who know what they're doing. And the question is simple. Were you the person who got shaken, or the person who got positioned? And today's preparation starts with understanding one ugly tool that almost nobody explains properly. Margin. That word is going to matter a lot in the next few minutes, because it's the lever that turns a normal pullback into a waterfall. So let's rewind to the sequence that raised my eyebrows. First, reports circulated that a major bank reduced or closed a large short position right as the market hit the low. Then, right as the price action got chaotic, a major metals trading venue experienced disruptions. Around the same window, another big institution tied to that venue reportedly faced systems issues too. And while all of that was happening, the futures exchange in the US raised margin requirements, forcing leveraged traders to either add cash immediately or liquidate. Then the timing gets even more interesting. The hard shove happened right when liquidity thins out and when a big chunk of global traders are away from their screens for the weekend. That's not a conspiracy statement. That's just how markets work. Thin liquidity makes big moves easier. Period. And then, like a match tossed into gasoline, headline risk hit the tape around central bank leadership. Suddenly the narrative had a villain, the talking heads had a reason, and everyone had something simple to repeat. But when you connect those dots, you get a different picture. Not proof of some movie plot scheme, just a realistic possibility that multiple pressure points hit at once, and the people closest to the plumbing benefited. Now, I'm John A.G. I'm not here to tell you bedtime stories. I'm here to help you see the mechanisms behind the move so you don't get emotionally farmed. And if you stay with me, I'm going to cover three things. First, what most likely triggered the massacre and who benefited from it. Second, why this crash doesn't fix the underlying silver problem. If anything, it makes the next phase more dangerous for shorts. Third, what moves you should be thinking about right now, depending on whether you're a trader, an investor, or someone who just wants to protect buying power. And the third part is where most people get it wrong, because they confuse price with value. We'll get there. Now let's put the move in perspective without getting lost in drama. When a market drops this fast, it's easy to assume the fundamentals changed overnight. Like something broke, like demand vanished, like the world suddenly decided silver wasn't important anymore. But that's not how real markets behave. Real fundamentals don't usually evaporate in 24 hours. What does change in 24 hours is positioning, leverage, liquidity, and the rules of the game for people using borrowed exposure. So here's the core idea you need to lock in. A sharp crash can be less about the metal and more about the players. And the players who get hurt first are always the most leveraged. That's not an opinion, that's math. In futures markets, most participants aren't paying the full price for the position. They're putting up a fraction of it, called initial margin, and they're required to maintain a minimum amount, called maintenance margin. If the exchange raises those requirements, it's like changing the speed limit while you're already on the highway. You can complain, sure, but you still have to slow down. And in market terms, slowing down means posting more cash immediately. If you can't post it, you have to sell. Now imagine thousands of traders in the same crowded trade, many of them maxed out, all being told at once, put up more money, right now, or get out. That's the part people miss. A margin hike doesn't just make trading safer. It forces liquidation. It creates forced sellers. And forced sellers don't negotiate. They hit the button. Here's the next layer. Forced selling pushes price down, which triggers more margin calls, which forces more selling, which pushes price down again. That's the cascade. That's the waterfall. And once it starts, technical levels get smashed like they don't even exist. So when you look at the chart and you say, wow, silver failed here, you might be blaming the wrong thing. It's not always a failure of the thesis. Sometimes it's a failure of the structure people were using to express that thesis. Now, why would an exchange raise margins right when a market is hot? Sometimes the innocent explanation is that volatility went up, risk models changed, and they adjusted. That happens. But here's the skeptical angle you have to consider. Raising margins at the peak is like opening the drain in a crowded pool. The weakest swimmers go first. And if you're a large player who's been leaning short, what do you want? You want the public to puke their positions. You want the momentum crowd to get carried out. You want the late buyers to get terrified. Because then you can cover your shorts into their forced liquidation. That's not a conspiracy. That's just how short covering works when liquidity is thin and fear is thick. Now, I want you to notice something important. The crash itself doesn't create new physical silver. It doesn't mine a single ounce. It doesn't make industrial demand disappear. It doesn't magically fill warehouses. All it does is change the paper price and shake out who's holding what. And that's why you have to separate the paper market from the physical market, because they are not the same world. The paper market is dominated by contracts, claims on silver, promises of silver, exposure to silver. It's fast, liquid, and heavily leveraged. The physical market is slower, more stubborn, and tied to real supply chains, mints, refineries, fabricators, industrial buyers, and people who want bars in their hands. In calm periods, the two markets track each other pretty closely. In chaotic periods, the paper market can swing wildly, while the physical market grinds along with totally different signals. And recently published numbers around industrial usage have continued to point in one direction. Silver demand isn't just a jewelry story. It's a manufacturing story. It's an electrification story. It's a data center story. It's a grid upgrade story. That matters because it means price shocks don't automatically kill demand the way they might for a purely speculative asset. Now, let's talk about the engineered flush idea, but like adults. Do I know exactly who pressed which button? No. Do I know that markets have a history of using rule changes and liquidity events to reset positioning? Yes. A long history. So instead of shouting rigged and moving on, let's look at the repeated pattern. Big rally, crowded trade, volatility rises. Then, margin gets tightened. Then, price breaks hard. Then, sentiment flips from euphoria to nausea. Then, strong hands accumulate while weak hands swear they're never touching it again. And then, later, price climbs again, often from a higher base, because the underlying demand and monetary backdrop didn't disappear. That's the pattern you should care about, because it's repeatable even when the headlines are different. Now, the competitor-style narrative you might hear is, this crash solved the silver shortage problem, or this crash means demand was fake. I'm going to challenge that. A paper crash can reduce speculative demand, sure. It can wipe out leveraged longs. It can cool off a mania. But it doesn't solve structural supply constraints. In fact, wiping out paper positions can make physical tightness more obvious because fewer people are willing to provide liquidity through futures. And when liquidity providers back away, the next move can be sharper, not smoother. So let's walk through who won the crash, because that tells you what might happen next. The winners in a forced liquidation event are usually shorts who can buy back lower, market makers who earn spreads during chaos, and long-term buyers who get better entry prices. And the losers are almost always leveraged longs who can't meet the new margin, people who bought late and used tight stop losses, and anyone who panics after the damage is already done. If you were using leverage on silver, this is the moment you learned a painful lesson. Leverage is a magnifying glass. It doesn't just magnify gains, it magnifies fragility. And I'm saying that without judgment. Plenty of smart people get caught in cascades because they're trading what they think is normal volatility, and then the exchange changes the rules mid-game. Now, let's address the headline about central bank leadership, because it did matter, but not in the way most people think. If markets think a new leader will be tougher on inflation, they assume tighter policy, higher real rates, and a stronger currency. A stronger currency tends to weigh on dollar-price commodities, at least in the short term, because it changes the math for international buyers. That's the clean explanation. But here's what gets ignored. These moves are often about expectation shifts, not reality shifts. A nomination headline doesn't instantly change the economy. It changes positioning around the idea of change. And when positioning is extreme, you don't need much of a shove. If the trade is crowded, all it takes is a spark to start a stampede. So yes, the headline may have been the spark, but the fuel was leverage, and the oxygen was a margin hike. Now, if you're thinking, okay, fine, but how do I know whether this was the bottom? That's the wrong question, because trying to nail the exact bottom is how you become liquidity for someone else. The better question is, what are the signals that tell me the flush is completing? And there are a few. Do you see volatility spike and then begin to compress? Do you see forced selling instruments get obliterated more than the underlying metal? Do you see physical premiums stay sticky even as paper price falls? Do you see sentiment flip from easy money to never again in a matter of days? When those show up together, you're usually closer to the end than the beginning. Now, let's add some fresh context that wasn't in the competitor script, because this is where real understanding lives. Silver isn't just a monetary metal, it's a critical industrial input. It's used in high-efficiency electrical contacts. It's used in soldering and brazing alloys. It's used in certain medical applications because of its antimicrobial properties. It's used in photovoltaic paste for solar panels. And even when manufacturers reduce the silver content per panel, the total number of panels keeps rising, which can keep total silver demand elevated. On top of that, grid modernization and electrification trends don't move in a straight line, but they have a direction. And from recent market updates, a lot of the future demand that people used to treat as optional is showing up as real orders. That matters because it creates a floor under industrial consumption, even when investors get shaken. Now, I'm also going to give you a counterpoint to the doom crowd and the hype crowd. The doom crowd says, this proves the metals are manipulated, so don't play at all. The hype crowd says, this proves silver is going to the moon immediately. Both are emotionally satisfying. Both can get you wrecked. The smarter view is, this proves silver is volatile, structurally important, and heavily financialized, meaning it can move like a currency and a commodity at the same time. That's why it rips higher when confidence cracks, and that's why it gets smashed when leverage is too one-sided. So if you're going to be in this market, you have to size it like a market that can swing hard in both directions. Now let's go into the history lesson, because the playbook has been around longer than social media. Back in the late 70s and into the early 80s, silver went into a blow-off phase and then got crushed after rule changes and forced selling. The public remembers the drama. They forget the mechanism. In the early 2010s, after the financial crisis era, silver rallied hard again. Then margins got tightened repeatedly and price fell fast. The narrative afterward was, well, the trade was over. Except it wasn't over. It was reset. Then in more recent cycles, we saw smaller versions of the same thing. Price surges into thin liquidity, then sudden pressure points hit, then a fast drop shakes people out, then the market finds its footing again. Different era, same human behavior. Fear and greed don't update with software patches. Now here's where I'm going to build a payoff loop, because you might be thinking, okay, John, I get the mechanics, but what's the real plan? The real plan, if you want to describe it in the most cynical, practical way, is to keep the public trading paper promises while the system controls the plumbing, because paper markets are easier to steer than physical markets. Paper can expand and contract quickly. Physical can't. And when physical gets tight, the only way to relieve pressure without raising prices is to shake out paper demand. That's what margin does. So when someone says they crashed silver, I translate it into a simpler sentence. They tightened the leverage valve. That's it. Now, does that mean the metal can't go lower from here? No, it can. Markets can overshoot in both directions. And I want to be crystal clear. If you're the type of person who can't handle another leg down, you need to respect that. There's no trophy for being stubborn. But if you're the type of person building a position over time, the question isn't whether you catch the exact low. The question is whether you're buying when fear is high and the long-term drivers are intact. Now let's talk about those drivers, because this is where the mainstream version goes silent. Silver sits at the intersection of two forces. One is industrial demand. The other is monetary stress. Industrial demand gives it utility. Monetary stress gives it narrative power. When both line up, silver becomes explosive. And in the last couple of years, we've had a weird mix. Industrial demand has remained resilient, while monetary policy has swung between tighten and please don't break anything. That indecision is rocket fuel for volatility, because markets hate uncertainty and metals thrive on it. Now, I'm going to tell you something that might irritate both camps. A crash like this can be bullish longer term, not because pain is good, but because it flushes leverage and resets positioning. The rally that follows a leverage flush is often healthier than the rally that came before it, because it's less dependent on borrowed money. And borrowed money is what gets killed first. So if your thesis is based on long-term supply and demand and currency debasement, you might actually prefer a flush now rather than a slow grind that tempts everyone to pile in with leverage. Now, here's where you should engage with me, because I want to know what kind of viewer you are. Are you holding physical, paper, miners, or none of the above? And do you think this was a natural crash or a forced flush? Drop your take in the comments because I read them, and the best comments shape what I cover next. Now, Let's get practical about what to do, because information without action is just entertainment. There are basically three categories of people watching. 1. Traders who want to capture short-term moves. 2. Investors who want exposure without getting whipped out. 3. People who want to protect purchasing power and sleep at night. If you're in category 1, you already know this market is a knife. Your job is not to be brave. Your job is to be precise. That means strict risk management, smaller size, and respecting that rule changes can nuke your setup. If you're in category 2, you need to think in layers. Entries spread over time, avoiding over-leverage, using pullbacks to average, not to panic. If you're in category 3, your edge is patience. You don't need to catch every tick. You need a plan that survives chaos. Now, I'm going to sprinkle in one reminder that matters more than any chart. If you're successful, share your success story in the comments so others can stay motivated. Because the comment section is full of people trying to stay calm while the screen screams red. Now, back to the who benefited question, because there's one more layer. During violent moves, the options market also becomes a weapon. Implied volatility spikes, premiums explode, and hedging flows can push price further than fundamentals justify in the moment. That's why you sometimes see a crash accelerate even after the initial sell wave. It's not just fear, it's mechanics. Dealers hedge, funds rebalance, risk limits get hit, and suddenly everybody becomes a seller for reasons that have nothing to do with silver as a metal. That's why did it drop, is often the wrong question in the short term. The better question is, what forced selling was triggered? Now, based on the latest publicly available filings and positioning reports that traders watch closely, metals trades can become crowded fast, especially when momentum is strong and everyone believes the same story. When everyone believes the same story, the surprise is never the direction. The surprise is the violence of the reversal. And that's what we just lived through. Now, let's talk about the claim that a particular bank closed shorts at the bottom. Even if you never prove intent, the optics matter. If a major institution repeatedly appears to benefit from these events, retail traders will feel like the game is stacked. That anger is understandable, but anger isn't a strategy. A strategy is knowing that when the crowd is emotional, the professionals are mechanical. They don't need to be evil. They just need to be disciplined. So the goal for you is to become less emotional and more disciplined. Now here's a cliffhanger you should sit with. If this was a reset, not a collapse, then the next phase isn't about whether silver is dead. It's about who controls the next move. And the next move could be sharper than the last one. Because when a market recovers after a flush, it often does it fast, and it often leaves people behind. You've seen it in other assets. The crash scares you out, the rebound happens quickly, and you're left watching saying, "I'll buy when it feels safe." But it never feels safe, not in real time. Now, I'm not here to promise price targets like a carnival barker. What I will do is give you a grounded framework. If the physical market stays tight, if industrial demand stays steady, and if monetary policy stays trapped between inflation and recession risk, then the long-term case for owning some exposure remains. If any of those conditions break, your plan should adjust. That's rational. Now let's talk about the monetary side for a moment, because silver doesn't move in a vacuum. Silver reacts to real rates, currency strength, and liquidity conditions. When real rates fall, metals usually breathe easier. When the currency strengthens hard, metals often get hit. When liquidity dries up, everything risky gets sold. The tricky part is that silver can behave like a risk asset during panics and like a monetary asset during slow burns. So you have to know what regime you're in. And here's the uncomfortable truth. In transitions between regimes, markets get violent. Which is why you just saw what you saw. Now, I want to address one specific point from the competitor narrative that I'm skeptical about. The idea that one announcement alone caused this crash is too simplistic. Yes, leadership expectations can move markets, but a move of this magnitude usually needs structure. Leverage, margin, thin liquidity, and a crowded trade. Otherwise, you get a dip, not a cliff. So if anyone tells you this was purely about one headline, they're either simplifying for TV or they don't understand microstructure. Now let me give you a simple mental model. Headlines are triggers. Structure is the weapon. Leverage is the fuel. Margin is the ignition. Liquidity determines how big the fire gets. That's the model. Now you might be asking, okay, John, what about gold versus silver? Why did silver get wrecked more? Because silver is smaller, thinner, and more leveraged. It's like the sports car of metals. It's faster, but it spins out easier. Gold is deeper, more institutionally held, and generally less dependent on industrial cycles. So in a forced liquidation, silver usually takes the bigger hit. That doesn't mean silver is worse. It means silver is more sensitive, and sensitivity cuts both ways. Now, I'm going to build another payoff loop because the next piece matters. If this flush was designed to cool off the trade, it may have also created a window where the paper price disconnects from the physical reality. And that window is where opportunities and traps hide. Because during dislocations, you'll see people bragging about buying cheap paper exposure, while physical premiums stay elevated and availability tightens. So the signal isn't just the spot price. The signal is the whole ecosystem: premiums, delivery times, inventory reports, and the way spreads behave between near-term and forward contracts. When near-term demand is intense, you can see signs like backwardation, where immediate delivery is priced higher than future delivery. That's not guaranteed, and it comes and goes, but when it shows up, it's the market whispering, "I want it now." And "I want it now" is never a bearish sentence in a physical commodity. Now, based on recently published numbers about manufacturing activity and energy infrastructure buildouts, the demand picture has remained more durable than people assume when they only look at price charts. That's new context. And it matters because the supply side of silver isn't infinitely flexible. Silver is often produced as a byproduct of other mining operations. That means supply doesn't ramp instantly just because silver price rises. So when demand jumps, supply doesn't necessarily follow quickly, which is why squeezes and shortages can appear more frequently than in commodities where production can scale faster. Now, let's move to the what now section because I know you want that. Here are the moves to consider without telling you what to do. If you were over-leveraged, your priority is survival, not revenge trading. If you got stopped out and you're furious, your priority is emotional recovery, not jumping back in out of spite. If you're a long-term holder, your priority is reviewing your allocation and making sure you can handle volatility without becoming a forced seller. And if you're new, your priority is learning the difference between trading paper and owning an asset, because paper is about timing, owning is about conviction. Now, a quick word on miners because miners confuse people. They're businesses with operating risk, so they won't track the metal perfectly. They can drop harder in panics and rebound faster in recoveries, which is why sizing matters. Now, here's one you need to hear. The most dangerous part of this story isn't what just happened. It's what happens when the market realizes the flush didn't fix the physical reality. Because that's when trust in paper starts to erode. And when trust erodes, people demand delivery. And when people demand delivery, the system has to prove it can deliver. That's the moment that separates a chart move from a structural event. Now, I'm not saying that moment is tomorrow. I'm saying that's the direction of risk when paper and physical diverge for long enough. And that's why you have to watch behavior, not headlines. Now, let's talk about what you should watch in the next 30 to 90 days. Whether margins stay elevated, whether open interest collapses and then rebuilds, whether physical premiums stay firm, whether the currency holds strength, and whether industrial buyers quietly step in on dips. If those factors line up, you can get a sharp rebound. If they don't, you can get more chop and possibly another leg down. Either way, the key is you don't want to be forced. Forced is the enemy. Now, a second time because this matters. If you're successful, share your success story in the comments so others can stay motivated. And if you want the deeper stuff, we also offer members-only videos produced by a separate team that goes more research-heavy. Those are only for premium members, and they're built for people who want the full breakdown without the public video pacing. Now, back to the core thesis. Did this crash weaken the silver case? I'd argue it didn't. It exposed the leverage layer, yes, but it didn't erase industrial demand. It didn't erase fiscal pressures. It didn't erase the reality that modern economies run on electricity, and electricity runs on metals. And it didn't erase the fact that monetary systems worldwide are still carrying massive debt loads that make high rates forever a hard promise to keep. So the bullish case, if you hold it, is still about the same pillars. The bearish case, if you hold it, is mostly about timing and risk-off phases. Both can be true in different windows. That's why dogmatism loses money. Now here's the last payoff loop. If you understand that the crash was about structure, you stop being surprised by the violence. And if you stop being surprised, you stop being easy to scare. And if you stop being easy to scare, you stop donating your position at the worst possible moment. That's the real edge. Not predicting the next headline, not screaming on social media, having a plan. Also consider a less dramatic possibility. Nobody planned it. Sometimes big funds share similar risk models, and when volatility jumps, they all de-lever at once. That can look coordinated even when it's just math. Either way, the takeaway is the same. If your position only works in calm markets, you're borrowing trouble. Build it to survive turbulence. So here's my closing ask. If you want me to keep covering metals, market structure, and how these flushes actually work, tell me in the comments. And if you think I'm wrong, tell me why. Don't just throw an opinion. Give me your best argument. Because the comment section is where we sharpen the thinking. And yes, the description includes bonus links, including a premium WhatsApp channel link and a channel membership join link. And now, the disclaimer. Because I'm not here to play games with your money. Everything you just heard is for education and general information. I'm sharing how I think about markets, not telling you what you should buy or sell. Make your own decisions, do your own homework, and if you need personal advice, talk to a qualified professional who knows your situation.